As we move into next year, I think it's really interesting because, if you think about the last 6 months for equity markets, they've been a huge beneficiary of policy, whether it be monetary policy or fiscal policy. And that has been the key driver of the repricing of assets in the equity markets. As we move into next year, what I'm really looking forward to is seeing something of an evolution with respect to the key driver. And so you're going to go, in my mind, away from policy being the key issue to profits being the key issue. And I think that's a really healthy transition to occur. The reason I'm confident with that is that when I look at the earnings forecasts for markets in this part of the world and globally for the next 12 months, we've at the very least seen a stabilisation in expectations for where those profits will go. But in some markets we're already seeing a recovery being forecast. And that again is really important, and I think a much healthier backdrop to equity prices sustaining the direction of their improvement. What that catalyses for us as investors is trying to work out, where do we put our clients' money to make sure that we get the most leverage off that type of profit recovery coming through in calendar year 21. And what we're looking to try and do is find those areas where profits are growing the most in an absolute sense, and also the most relative to expectations in the markets. And we've been very careful with the way that we've built portfolios given that backdrop, and we're looking very much to try and go overweight those areas which are more sensitive to the economic cycle. So what we've been doing is buying businesses that operate in travel, so companies like Auckland Airport and Sydney Airport. We've been buying companies such as the private hospitals in Australia, so Ramsay Healthcare, which is, in our opinion, going to be a huge beneficiary of the resumption of elective surgeries as we move into the back end of this year into calendar year 21. So again, that's been important for us. Companies like Mainfreight's been great. Freightways is another one which we really do like, and becoming increasingly confident around the investment thesis on that. And what Freightways is benefiting from is what appears to be a sustainable lift in parcel volume, so that's great. And they're also enjoying a much more supportive and productive pricing environment. So recently, Freightways have introduced a pricing for effort sort of philosophy around the way in which they conduct business with customers, and that really is just a way of differential pricing relative to the different levels of difficulty associated with different deliveries. Again, it makes pretty obvious sense, but customers are increasingly becoming supportive for that as well, which is really great. One of the challenges for pricing in the courier market here in New Zealand has been NZ Post, which is the big competitor to Freightways. And it would be our opinion that they haven't always conducted themselves in the most commercially sensible way around pricing. But recently they made some decisions around some quite major capital investment, and to justify that and to generate a return on that investment, they also are leaning towards sort of price increases in what they do. So that backdrop looks very good for Freightways. They're also doing a really good job in terms of managing sort of run delivery density. And that's also lifting, certainly productivity and lifting the margins that that business is enjoying. So I think net that type of company enjoying that sort of backdrop for us is a perfect example of the way in which we are looking to allocate capital as we move into next year, both from a company-specific basis and also from an economy which we believe will just continue to improve.